The yield curve in the United States has been inverted for over 700 days, the longest period of time since 1929, right before the worst economic downturn in recent financial history. When the yield curve is inverted, it gradually chips away at the economy, making it more and more vulnerable to an outside shock that could trigger an economic downturn. Throughout history, each shock that triggered a recession was different, but the common denominator is that these recession shocks always seem to happen when the yield curve is inverted, and the U.S. economy enters a slowdown every time. But today, despite the yield curve having been inverted for a record amount of time, and many signs that the economy is currently experiencing underlying weakness, we still haven't seen any big shock that can finally trigger a recession. For the most part, the economy has actually been holding up quite well despite the inverted yield curve. And this has led to one of the most expensive stock markets in history, more expensive than in 1929 and almost as expensive as 1999, two dates that were followed by quite extreme market crashes. But it's not just the stock market that's expensive today. The housing market is also at one of the most expensive levels of recent financial history. The ratio between the price of homes in the U.S. and household income is now at 7.7. We've never seen such an expensive housing market throughout financial history. It makes housing around 2 times more expensive than what it was during this 40-year period between the 1960s and 2000. All of this puts the Federal Reserve, the U.S. central bank, in a major dilemma today. On the one hand, if they begin to cut interest rates, they risk seeing major asset bubbles form in the stock and housing markets, if that's not what we already have today. Ever since the Federal Reserve announced that they were pausing interest rates in October of 23, the S&P 500 has surged by 40% within 9 months, which is again a speed of ascension that we've rarely seen throughout history, except in a few very famous instances. So if the Federal Reserve decides to cut interest rates throughout 2024, they risk seeing a euphoric bubble form on the stock market, but also on the housing market. And we all know what happens when bubbles pop. On the other hand, if the Federal Reserve doesn't cut interest rates soon, they could be creating a very severe recession when the economy finally breaks. After the 2008 financial crisis, Ben Bernanke, the chair of the Federal Reserve at the time, said that in hindsight, they should have cut interest rates sooner. That's why the Federal Reserve, that currently has the highest interest rate since the 2008 financial crisis, is very likely to cut interest rates throughout 2024. And you can see financial markets are already pricing that in. The 2-year yield that you see on this chart is a reflection of what the market thinks the Fed is going to do. And you can see quite often you see the 2-year yield falling before the Federal Reserve actually cuts interest rates. That's exactly what's happening right now. And we can see what happens to the stock market every time that the 2-year yield is falling like today. It has created significant market rallies throughout 2023 and 2024. And the very opposite was true throughout 2022 when the 2-year yield was rising and the stock market was falling as a result. So with the 2-year yield falling today, pricing in that the Federal Reserve is going to cut interest rates, does that mean that the mega stock market bubble scenario is right in front of us, which could lead the market to absolutely crazy valuations? In order to answer that, we need to look at this chart right here. This is an index called the MOVE Index, and it shows us the volatility of interest rates over time. So in other words, how much uncertainty there is in the bond market. You can see, for example, this was during the 2008 financial crisis, lots of uncertainty. This was during the COVID pandemic, lots of uncertainty. And this was during 2022 when you had inflation, oil shocks, and the Federal Reserve was raising interest rates. The combination of these factors led to the highest uncertainty in the bond market since the global financial crisis. And we can see that this index is actually still quite elevated today compared to, for example, before the pandemic. Now, when we flip this indicator around and we add the chart of S&P 500 valuations, they're pretty much a mirror image of each other. This is a chart that we've shown before, and it shows us exactly why the stock market could actually be heading into much crazier valuations. That's because every time that uncertainty in the bond market goes in this direction, we see the valuations of the stock market go up. And of course, the very opposite is true when bond market uncertainty goes in this direction. And so what this chart tells us is that if bond market uncertainty were to make this type of move, the valuations of the S&P 500 will likely be heading in the same direction. And by the way, this has been our thesis since late 2023 and why we expected that stocks could surprise everybody to the upside despite these high valuations. This strategy has enabled us to make some incredible trades throughout 2024, allowing our clients to benefit from this raging bull market that we've been in. But at one point, the MOVE index is going to turn around, and as that happens, stock market valuations will also turn around. When the recession that we talked about earlier in this video finally occurs, this is something that we would expect to happen, similar to how the 2008 financial crisis triggered a lot of bond market uncertainty and declining stock market valuations. And that's where exorbitant market valuations on the S&P 500 puts the stock market at risk of a much larger correction when things do turn around. We follow all of these developments and highlight our exact trading strategy week by week to our members at gameoftrades.net. Grab yourself a subscription if you want to join our community.